markets started showing us indecision yesterday and did the same thing today. Stochastics just now getting into the oversold area. What's this kind of implying? That we're probably getting near a bottom. It wouldn't be unusual to see a spike of the Dow down to the 200 and bounce up from there. At the same time, the Nasdaq has reached the 200-day moving average when the stochastics have now gotten into the oversold area. Even though we haven't seen very strong days, it's still holding here at the 200, probably in anticipation or waiting for the Dow to finally hit its support level before everybody will start coming back in if they're going to move this trend back to the upside. This type of analysis becomes very easy when you can see the graphics of the candlestick signals and what they're telling you at important technical levels. For example, did we expect any huge selling from here with the Nasdaq doing a doji that bounced just off the 200? Not necessarily, because it was already getting toward the oversold area. It was kind of inferred that this area would act as support. A major benefit of the candlestick signals is that you can extrapolate what is going to occur quite often based upon a candlestick pattern. For example, notice up in the overbought condition we had a bearish engulfing signal. The next day we had a doji. Doji has a very simple information and rules to it. Number one, it tells us there's indecision. And number two, very simple rule is that they're going to move it in the direction of how they open it after a doji. And number three, it usually will create, if it opens lower, a third day, which is equivalent to the first big down day before the doji. This is what we call a doji sandwich. And that doji sandwich usually is a pretty powerful indicator that the downtrend will continue until we see a major candlestick buy signal and a close above the T-line. In this case, we had it here, but we reshorted. Still in a downtrend, it can't get up above the T-line. The candlestick signals, especially using the T-line, our 8 exponential moving average, provides a very strong format for investors to not be zigzagged out of positions and to stay in positions as long as they're profitable. That'll be it. We'll see you in the chat rooms.